Alex, is the Job Guide 360 interview guide worth it?
Honestly, yes, the guide is highly insightful. I recommend it to everyone.
Welcome to your deep dive. Today, we're really unpacking a comprehensive blueprint, basically designed for anyone aspiring to be an investment analyst.
Hi.
But honestly, even if you're not job hunting right now, this material, it gives you a fantastic framework for understanding the core skills, what you need to thrive in finance, or even just sound, really well-informed.
Exactly. And we're looking at sources that go beyond just common interview questions. They give you the analytical thinking behind the best answers.
Okay.
So our mission here is to pull out those essential nuggets, the technical skills, the strategic view, and crucially, the communication piece that makes a great analyst.
So we're structuring this around three main pillars then. First, the tools and the data side of things. Second, how analysts link those big economic trends, the macro stuff, to specific investment choices.
Yeah, that connection is key.
And finally, the soft skills managing risk, getting your point across effectively. Okay, let's unpack this. Right, so starting with that technical toolkit, we have to talk specifics, don't we? It's not really enough anymore to just say, I know Excel.
Oh, definitely not. The source material really hammers home the need for industry standard platforms. Think Bloomberg. Think FactSet.
You have to show you're comfortable with those for real-time market data and digging into specific assets.
Absolutely. That's table stakes. And that proficiency, it leads right into efficiency. So when we talk Excel, we're not talking basic spreadsheets. No. The guide emphasizes using advanced features, specifically integrating VBA that's Visual Basic for applications to automate tasks.
Okay, VBA. So you mean actually writing little bits of code within Excel?
That's exactly it. Using code to, say, pull data automatically or run the same calculation across hundreds of rows instantly.
Wow. Okay. So we're talking about potentially saving hours of just manual copy pasting or formatting each week?
Precisely. That's a massive efficiency gain. And frankly, it's why employers want to see it. You automate the grunt work, you free up brain power for actual analysis.
Makes sense.
And that need for scale, it also pushes towards handling really large amounts of data. The source specifically mentions using Python scripts.
Python. Okay, getting into proper programming now.
Well, for specific tasks, yes. Streamlining data extraction, cleaning up massive data sets, even visualization. If you're analyzing, say, the entire sector, Python can process and chart that information much faster, much more reliably than Excel alone ever could.
Okay, so this power to handle complex data, it naturally leads into the modeling side, right? How does an analyst actually put this technical skill to work?
Yeah, it starts with the core of valuation. You absolutely must be comfortable building discounted cash flow models, DCF models.
DCF, right. That's the classic way to figure out what a company's actually worth today based on its future earnings potential. Essentially, yes. Based on projecting its future free cash flows and discounting them back to the present. It's kind of the theoretical gold standard for figuring out intrinsic value.
Okay, but those future projections, they're based on assumptions, aren't they? And assumptions can be wrong. How do analysts, stress test these models?
Great question. They use two key techniques, mainly. First is sensitivity analysis.
Sensitivity analysis.
Yeah, it's basically a sophisticated what-if game. You take one key assumption, maybe future revenue growth or the discount rate, and you tweak it slightly. See how much your final valuation number changes.
So it shows you where the model is most vulnerable, like which assumptions have the biggest impact if they're off.
Exactly. It highlights the model's weak points. And the second technique is scenario modeling.
Okay, how's that different from sensitivity analysis? That was changing one thing at a time.
Right. Scenario modeling is broader. It lets you compare entirely different potential futures. So maybe you're looking at an acquisition. You could model a base case with your current expectations.
An optimistic case where everything goes perfectly, synergies are high. And then a pessimistic case, maybe a recession hits, integration fails.
Got it. So you can lay out different strategic paths and understand the risks and rewards of each one?
Precisely. It helps decision makers see the range of outcomes and set their risk boundaries.
Okay, let's shift gears now, moving from the detailed spreadsheet view up to the big picture, connecting macroeconomics to investments. This is fascinating, right? How broad trends like interest rates or inflation actually affect specific stocks or bonds.
This is where the strategic thinking really comes in. Every single investment decision has to be grounded in what's happening in the wider economy. Take inflation, for example.
Okay.
If inflation is rising sharply, that's a signal, right? Central banks might react, tighten monetary policy, maybe raise interest rates.
And that matters because
Because it directly impacts the discount rate used in those DCF models we just talked about. Higher rates generally mean lower present values for future cash flows. It hits bond yields, it hits equity valuations pretty much across the board.
Yeah.
An analyst has to anticipate that.
So the source material insists on staying current with actual market events. Let's use their example. The Bank of England changes interest rates. Say they hike rates. What's the immediate ripple effect an analyst needs to think through?
Okay, good example. First, you follow the money. Higher rates mean borrowing costs go up. For businesses, for consumers buying houses or cars.
Right.
So the first ripple, sectors that rely heavily on debt might struggle. Think real estate, maybe heavy industry, construction. Mortgages get more expensive, business loans cost more, growth could slow there. So you'd approach those cautiously.
Okay, makes sense. So who potentially benefits from higher rates?
Well, the second ripple often hits the financial sector. Banks, lenders. They can often charge more on the loans they make when rates go up, potentially widening their margins.
Oh, I see.
So the analyst sees that Bowie rate hike and immediately thinks, okay, maybe trim exposure to those debt-sensitive areas, perhaps look closer at financials. It's about connecting that macro event directly to portfolio strategy.
So given all this economic uncertainty, market swings, the perennial question is always, where's the opportunity now? Does the guide give any pointers on sectors maybe looking interesting for the long term?
It does highlight a couple of areas where maybe the long-term story is being overshadowed by short-term noise or volatility. Renewable energy is one they mentioned.
Renewables, despite maybe regulatory hurdles or high upfront costs.
Exactly. The argument is that while there's short-term uncertainty, the global push towards climate goals creates this massive long-term demand tailwind. So the current choppiness might actually be an entry point for investors with a long horizon looking past the immediate bumps.
Interesting. And what was the other sector?
Certain parts of biotech. Now, this is inherently risky, obviously.
Sure. One trial failure can sink a stock.
Right. But the potential is huge, driven by medical breakthroughs, aging populations. The key for the analyst here is separating temporary setbacks, maybe a disappointing trial result, from the fundamental long-term science and intellectual property of a company. Finding those diamonds in the rough.
Okay. That sounds like it requires staying incredibly informed, constantly absorbing information. How do analysts actually manage that? Where do they get their information?
It's definitely about using a mix of sources. You need the core, reliable financial news, things like the Financial Times, Bloomberg, obviously.
Plus standard go-tos.
Yeah, but you also need the primary sources, company filings, central bank reports. And increasingly, you see external commentary and analysis on professional networks like LinkedIn, getting insights directly from specialists. Plus, sector-specific newsletters, webinars. You need a diverse diet to avoid blind spots.
Right, avoid the echo chamber. Okay, let's pivot again. We've done the technical tools, the macro strategy. Now let's talk about the analyst mindset, those crucial soft skills. And the absolute foundation has to be accuracy, right? Trustworthiness. How do analysts actually build that into their work?
It really starts with discipline. Rigorous verification is key. You have to cross-check your data. Don't just pull a number from one place. Verify it against multiple, independent, trusted sources before it even gets into your model.
So data validation first. What else?
A clear, methodical process for building your models, using error check templates, documenting your steps, and importantly, having peers review your work. A second pair of eyes catches things.
Okay, that helps catch calculation errors. But what about, unconscious biases creeping in, like only looking for data that confirms what you already think?
Cognitive bias. That's a huge challenge and often the hardest part. Good analysts are actively aware of biases like confirmation bias or maybe anchoring bias. Yeah, where you rely too heavily on the first piece of information you saw. They have to consciously fight it. Ask themselves, what assumption am I making here? What if it's wrong? Could that completely change my conclusion? It requires real self-awareness and self-criticism.
Okay, so accuracy first. Next up, risk assessment. And the guy stresses this is much more than just looking at how much a stock price bounces around.
Absolutely. Volatility is just one piece. A good analyst needs a framework to think about different types of risk. They mentioned market risk, which is that general market movement.
That's right.
Credit risk, the risk that someone you lent money to won't pay you back. Liquidity risk, which is, can you actually sell an asset quickly without tanking the price? Think trying to sell a huge office building overnight versus selling shares in Apple.
Right, very different.
And operational risk, things going wrong inside the business itself, like fraud or system failures. You need to consider all of these.
And how do they try and measure these risks, put numbers on them?
They use specific tools. The source mentions value at risk, or VAR. VAR tries to estimate the maximum dollar amount you could likely lose on an investment over a set period at a certain confidence level.
Sort of a worst-case scenario number?
Kind of, yeah, within statistical probabilities. And for stocks, understanding beta is crucial. Beta tells you how much a stock tends to move compared to the overall market. A beta over 1 means it's typically more volatile than the market. Under 1, less volatile.
Got it. So you're quantifying the potential downside to balance against the potential upside.
Exactly. It's about making risk-adjusted decisions.
Okay, last piece of the mindset puzzle. Communication. You could have the most brilliant analysis, but if you can't explain it clearly, especially to people who aren't finance experts,
it's worthless, basically.
Yeah.
Communication is how your analysis actually has impact. The key things are structuring reports logically, using simple, precise language, cut the jargon where possible, and, this is important, using relatable analogies.
Analogies. Can you give an example of how that might work in practice?
Sure. Let's say you're explaining high market volatility. Instead of just saying, well, this standard deviation is elevated and inter-asset correlations are negative, which means nothing to most people.
Right.
You might say something like, look, the market feels like sprung weather right now, very unpredictable, sunny 1 minute, hailstorm the next. So, just like you'd pack an umbrella, in your portfolio, you need some defensive assets right now.
Ah, okay. That makes the abstract concept feel much more tangible. I get it.
Exactly. It connects.
And what about handling feedback? Because analysis will get challenged, right? Sometimes maybe quite bluntly.
Oh, constantly. And handling that well is critical for growth. The key is to see criticism not as a personal attack, but as, well, free consulting, a chance to make your work stronger.
So don't get defensive.
No. Actively listen. Ask clarifying questions. Can you tell me more about why you disagree with that assumption? Then, go back. Review your work with those points in mind, with fresh eyes. Maybe they caught something you missed. That process ultimately makes the final recommendation much more robust because it's been pressure tested.
Okay, great advice. Let's shift to the foundational work now, the actual research process. How do you really dig into a company and its industry? The source gives a pretty detailed checklist here.
Yeah, and it starts with some proper investigative work, not just a quick Google search. Go to the company's own website, absolutely, but specifically hunt down the investor relations section.
Investor relations, okay.
That's where the company speaks directly to the market. You'll find financial results, annual reports, presentations, transcripts of earnings calls. It's where they lay out their performance and their strategy. It's gold dust.
And beyond the official company line, we're not just limited to annual reports these days, are we? The guide mentions using social media too. LinkedIn, Twitter, Facebook.
Right. And that's important for the qualitative side of things. Financials tell you what's happening, but checking out, say, executive profiles on LinkedIn, seeing what employees are saying, maybe on Glassdoor too, how the company presents itself publicly, that gives you a feel for the culture, the leadership, potential red flags maybe.
Like, if the numbers look great, but everyone seems miserable working there.
Exactly. That might suggest future problems, instability. Even if the balance sheet looks okay today, it adds crucial context.
Okay, back to the numbers though. When you're digging into the financial statements, income statement, balance sheet, cash flow, using platforms like Yahoo Finance or Bloomberg, what are you actually looking for?
You're not just looking at the static numbers, you're looking for trends in relationships. Is revenue growth accelerating or slowing? How is debt changing relative to equity or assets? Is cash flow from operations consistent, or is it lumpy? Are margins expanding or contracting?
So you're hunting for patterns, anomalies, things that don't quite add up and need more digging.
Precisely. Where are the numbers diverging from the story the company tells? That's where the interesting questions often lie.
And then zooming out again, understanding the whole industry the company plays in, the competitive landscape.
Crucial. You can't value a company in isolation. You need to use industry-specific research resources. They mention places like IBIS World, Statista, Market Research.
What do those give you?
They provide detailed reports on industry size, growth rates, the major players, key trends, regulatory issues, competitive dynamics. Is this a growing industry or a shrinking one? Who are the main competitors and how does this company stack up? What are the big threats or opportunities for the whole sector? You need that context.
This level of rigor, it seems like it needs to continue long after you've actually got the job, right?
What about ongoing professional development?
Oh, absolutely non-negotiable in finance. Things change too fast. The guide stresses continuous learning. That means pursuing recognized certifications, with the CFA Chartered Financial Analyst being the big one.
The gold standard, pretty much. But also attending industry conferences, networking, taking online courses, maybe in specialized areas like advanced modeling, data science, ESG analysis. You have to keep sharpening the saw.
Right, staying current. And, almost forgot, we have to mention the very specific detail they included on dress code.
Ah, yes. Presentation matters.
It seems so. The requirement listed is pretty clear. Dark-colored business suit, white or a light-colored dress shirt, a conservative tie, polished black shoes, and keep accessories minimal and professional.
It sounds traditional, but it's about projecting professionalism, attention to detail, seriousness. In some corners of finance, it absolutely still matters. It reinforces that trustworthiness we talked about earlier.
Fair enough. Details count. Okay, so we've covered a lot of ground here. From the technical deep dive into tools like VBA and Python,
The nuts and bolts.
to the strategic thinking needed to connect, say, inflation or interest rates to specific sector bets.
Linking macro to micro.
And then all those crucial soft skills, ensuring accuracy, assessing different kinds of risk, communicating clearly, handling criticism constructively. You listening should now have a really solid grasp of the whole skill set.
Yeah, and if you pull back and look at the big picture, all these skills, from getting the data right in a spreadsheet to managing a tough conversation about your analysis, they all point to one thing: making smart, informed decisions under pressure. That's the core job.
Making sense of complexity and acting on it.
Exactly. And delivering that analysis with clarity and confidence. Now, this guide, it really emphasizes preparation, right? Knowing the answers, doing the thorough analysis.
Definitely being ready for anything.
But here's a final thought to chew on. In the real world, when a true crisis hits, maybe a market flash crash, an unexpected geopolitical event, the hardest decisions often have to be made with incomplete information. The data just isn't all there, or it's contradictory.
Right. You don't have the luxury of perfect knowledge.
Exactly. So if meticulous thoroughness is the analyst's mantra, how do you learn to trust your analysis, trust your judgment, and make a call when the foundation, the data itself, is fundamentally shaky or incomplete? That ability to exercise sound judgment in uncertainty, that's arguably the ultimate